Okay. Hi everyone, I'm Dava Chemistry, Program Manager of MedTech basically at Cicada Innovations. Welcome and thank you for joining us today for our very first virtual monthly buzz. We're really excited to kick this off in the new format with today's webinar, Raising Capital in a COVID-19 World. The last time we checked registrations last night, we were at 420, so clearly this is a topic that is on everyone's minds and we're really excited to share it with you today. So before we begin, in the spirit of reconciliation, Cicada Innovations acknowledges the traditional custodians of country throughout Australia and their connections to land, sea and community. We pay our respects to their elders past and present and extend that respect to all Aboriginal and Torres Strait Islander people here today. So for those of you who don't know us, Cicada Innovations is Australia's pioneer deep tech incubator. So we're supporting startups and scale-ups solving the world's biggest, most pressing problems. We basically bring together entrepreneurs, researchers, investors and mentors together to create this unique melting pot of business, industry and science. For us, we're always looking forward to what's next in deep tech. So we're always aiming to help solve current problems, but also those of the future. We're excited to be able to continue to provide support to the ecosystem in a virtual capacity at this really, really difficult time. So I'm sure you're all really feeling the shocks of COVID-19 as it affects all aspects of our lives. And you're probably wondering what the major impact of this is going to be as we move forward. For startups and founders who are either in the process of raising or need to raise now to ensure they have enough runway to survive, this pandemic is a really critical juncture. As a previous founder myself, I understand how hard it is to raise capital in general, and I can imagine how much more daunting it must be at this really trying time. So we have about 150 people already online and we've an hour to pick the brains of 4 of the most prominent venture capital firms in Australia, all with an interest in deep technologies. On the webinar today, we have Sam Wong, partner at Blackbird Ventures. I might get you to give a wave, thank you. Mike Nichols, partner at Main Sequence Ventures. John Henderson, partner at AirTree Ventures. And Michelle Deeker, partner at OneVentures. So Sam, Mike, John and Michelle have generously agreed to participate in this 1-hour webinar. They're going to be talking about how they are looking at investing currently and what advice they have for founders raising at this difficult time. And they're here to answer all of your burning questions, so use the time wisely. I really don't want to take up too much time because we only have an hour. The basic format will be a few questions from me for around 20 minutes, and then we will start to open up to the floor for about 25 minutes. So to ask questions, please use the Q&A function at the bottom of your screen during the call. You can click a thumbs up, I've been told, to upvote existing questions that you may also want to ask or you're interested in hearing the answer to. So we might get stuck into it. I might start with John, because you're at the top corner of my screen. Get the panelists just to introduce themselves and let us know who they are and where they're from.
Yeah, sure. Thanks, Darka, and hi, everyone. I guess first and foremost, I hope you're all safe and sound and that your teams are as well. This is an unprecedented situation, and so I think we're all experimenting with Zoom panels and everything, so bear with us through this. As far as I'm concerned, I'm a partner on the investment team here at AirTree. We are a large Australian venture fund, backing founders aiming to build huge companies. I think today's panel is focused on deep tech, and so I'll highlight some of our deep tech investments like Celestial, which we invested in their pre-seed round. That's a space laser network. Fluorosat, which is a data analytics platform for agricultural yields, which we've invested in alongside Mike at Main Sequence. And Inventure Life Sciences, which is a 3D biocell printing company alongside Blackbird and Main Sequence. AirTree, we were actually quite fortunate on our timing in the sense that we raised our latest fund, which is 275 million in October of 2019. So we are genuinely open for business, actively investing. We've issued 3 term sheets in the last month. And so I guess a big part of the reason I'm here is to try and meet more great deep tech founders who we can back over the next 3-5 years.
Thanks, John. Maybe we'll throw it to you, Sam.
Excellent. Hi, everyone. I'm Sam Wong. I'm a partner at Blackbird. Blackbird is originally Australia only and now Australia and New Zealand. I'm actually in Auckland right now. VC fund. We have about $500 million under investment. We've invested in 67 companies over the last 7 years. About 50% of our investing is in deep tech. And within that sort of broad church, we invest in everything from synthetic biology, clean meat, space, robotics, AI, particularly with the digital health bent, as well as your standard SaaS companies. We are actively investing right now, and we're also actively fundraising. So I feel a little empathy with the situation that founders are in, and looking forward to hearing your questions and hopefully helping you through this period.
Thanks, Sam. Mike?
Hi, I'm Mike Nichols, partner at Main Sequence Ventures. This is Zareg land that I'm on at the moment, so acknowledge the owners and traditional elders, past and present. We are a $240 million fund, originally set up by CSIRO and the federal government as part of the National Science and Innovation Agenda. We subsequently raised a whole bunch of money from outside as well, superannuation funds, as well as sovereign wealth funds. Our primary objective in life is to help liberate, if you like, research out of public institutions, universities, CSIRO, Data61, CRCs, or to back startups that are working with those universities. So in other words, using public research to turbocharge those startups. So we only do deep tech. We've done 25 companies now. We've probably got a couple more, room for a few more of them in this fund. We are also in the process of fundraising as well, so we know how that feels. So we have some empathy here as well. But there is still a little bit of room left in the current fund as of this morning. So there's still some opportunities there. That's it for me.
Thanks, Mike. And finally, Michelle.
Hi, I'm Michelle Deaker. I'm managing partner of VC firm OneVentures. We've got about 400 million under management. We invest in both technology and healthcare. So we do quite a lot in clinical healthcare. So we do medical devices, diagnostics, therapeutics, then help them go through the clinical development pathways, as well as investing in other areas of deep technology, like we have AR, VR companies. We've got AI. We're sort of working, really across the spectrum of technology businesses. We've got about 200 million we're still investing, so we are open for business across 2 of our funds. We've got a venture credit fund as well that's actively investing. So sometimes this product can be used to extend your capital runway. I started life as an entrepreneur. I've actually taken a company through a tech crash and out the other side. And I've also raised a first fund through a global financial crisis. So I totally understand what all you guys are going through, and hopefully I can share some of my insights in the course of this webinar.
Fantastic, thank you. Well, while we have you, Michelle, we might start the first question with you. So do you agree that founders should be trying to raise now? And when is it prudent to raise? And when is it prudent to wait? How do founders of small businesses even make this decision? And seeing as you've been through it, perhaps you can shed some light on your personal story.
Yeah, look, obviously, you raise money because you've got to keep your company functioning. And so you've got to look at the situation your company's in. And one thing I would say is, you've just heard from Sam that they're out trying to capital raise. We're also raising another fund at the moment, but it's becoming increasingly difficult to raise funds whilst COVID-19 exists in the world. So, investors are just becoming more wary. They're also looking at opportunities for where they can invest their capital. So I actually think now people actually have some capital, but you might find that in a year or two's time, the capital markets are going to become scarcer than they have been. So 2019, there was a huge amount of capital raised into venture firms around the world. So despite the fact that everybody sat back and looked at their portfolios and probably reallocated some of the money that they had available to existing portfolio companies, they've made that assessment now, and now they're still open for business and they're still looking for their next big opportunity. So I actually think you're better off getting ahead of the curve. And if you're seeking capital, go out to try and find capital now, but make sure you've got a good story. Obviously, if your business has been severely impacted by the crisis, then you might want to reflect on when is the right time to raise, or you might want to go in and say, here's where my business was. We know we're going to come out strongly, and we want to actually keep moving forward at the plans of our company and show a good plan to the investors of what you believe your company will look like when we come out of this, because we all know we will eventually turn the corner on this crisis. We just don't know what the timing of that is. And we all want to be involved in the best businesses that literally slingshot out of the crisis and can establish a dominant position post-crisis.
And when you say plan, do you feel that the plan has changed what was, compared to what people were previously, rocking up with to say, here's where we're going to go next? Should they be thinking about that differently?
Look, some of our portfolio companies have changed their focus a little bit. So some were starting their offshore expansion, and some of them have delayed that but refocused on their local market. Australia is a little bit lucky because some business actually have the opportunity to establish a business here and to grow a business here. But almost all our companies are globally focused and born on day one. So, and you can build a great business out of Australia now. We live in this global world. We're just showing how quickly we can digitize our economies, how quickly we live, how quickly we can communicate in Australia or overseas. So, you should be planning your business as if the world will eventually return to normal. But there might be short-term plans, medium-term plans and long-term plans in those scenarios.
Yeah, gotcha. Sam, has COVID-19 affected your investment approach, the methodology and the strategy, and what sort of deals or companies you're actually looking out for as investors?
I have to say it hasn't. And the reason is that we invest on the horizon of a decade, and we know that the effects of COVID are really going to be felt probably over 2 years until a vaccine is available or herd immunity is achieved. And it's a funny kind of period of time because 2 years sort of isn't enough to start from scratch and get a product out there in the world and actually really working, whether it's software or otherwise. It's certainly not enough in biosciences. And so if you were starting today in a new thing that was, addressing COVID, the chances of you kind of actually getting an inflection point on that time frame is really low compared to someone who is already starting. So we're not really changing what we're looking at today based on what's happening around us at all. Obviously, some industries and markets and opportunities and problems are getting, the advantage of tailwinds that are created by COVID, and we're really excited about entrepreneurs, honestly, who are actually running at opportunities or have seen an opportunity to do something differently, whether it's, okay, no one's doing in-person meetings, great, I'll do them remote, where I used to have to invest in an enterprise sales force on the ground, or supply is really cheap to acquire now because ad sales have dropped. I'm just giving a couple of examples. So people who are approaching this sort of crisis as an opportunity to do something differently and run at it, that's very attractive to us. But the underlying problems that are there to be solved in the world, not really. We're still looking for really big, ambitious problem solving founders, basically.
Gotcha. Is anybody doing anything differently to what Sam's saying out there in your funds?
Look, I guess I'd make the comment that I think everybody in VC world initially in the first month of this probably spent a big chunk of their time making sure their existing portfolio was okay. I know we did. Just make sure they've got 12 to 18 months worth of cash, spend some time to ensure that anybody that had less of that worked out a plan to actually make sure that they could make it, because this might be 12 to 18 months before we start to see, some green shoots again, and we start to see some recovery. And the capital markets, as Michelle said, could be very well frozen in 6 to 12 months or so. We're not entirely sure. So our first focus was to make sure everybody was okay in the portfolio, and then to start to think about, okay, well, what new investments will we make in that situation? I would say to answer your original question around should you go out and raise capital right now? Well, as Michelle said, you've got to stay alive. So if you need to raise capital right now, absolutely you should. But what I'd say to you is I think the valuations are depressed. compared to where they were. Certainly, I've seen, example, company I really liked last year that I thought was way too expensive, but I ended up rejecting because I thought they were way too expensive. Had a pre-money of 35 million, and then just got a term sheet 2 weeks ago for 15 million pre. So big difference between 4 months worth of time and the valuation. Now that's just one data point, but I think you probably find that will, right now would probably not be the ideal time to raise from a valuation perspective. But if you have to do it, you have to do it.
Do you think it'll be better in 12 months? No.
To be honest, I'm really not sure, Sam.
Yeah.
I'm really not sure. But I feel like we've got this problem at the moment. It's really tough to make money in equities. There's no money in bonds or in interest. So where is the money going to flow? So flow to PE, flow to maybe not to PE at the moment. Maybe VC will be a place that some of it will end up. Maybe that'll free up. I think at the moment there's a bit of a problem with the large funding organisations, the super funds, the sovereign wealth funds. They normally get their plans, their investment plans approved for certain allocations, this much to equities, this much to bonds, this much to cash. And right now, because they've had a massive drop in their equities, their investment plans are completely out of what they've agreed with their investment board, and then possibly also with the government of their country. And their customers. And so they actually can't go and throw a stack of money into VC right now because they've got that structural problem. So there is a little bit of a problem there, I think, Sam, with the longer term, 6 to 12 months until the equity situation recovers. It might be a little while till that comes back into play.
Yeah, I think it's going to be some time before valuations recover. I think they were pretty frothy about a year ago, actually, and we held back on a number of investments for that reason, similar to Mike. And now we think valuations are going to become more reasonable. But one of the approaches that one of our portfolio companies is taking is, even though they actually don't need to raise capital because they're profitable, they actually think that they will still try to raise capital now because they want to be in an opportunistic position when we come out of the crisis to exploit their business and run harder and faster. So that whilst they recognise the fact they're probably going to take a step down on valuation, they actually want to have a war chest to be in the best and strongest position out of the crisis. And what you also have to remember is the way venture investors view this is our exit horizons are probably pushed out like 12 months, maybe longer on investments. And so we take that into account in valuations because we're looking at the time cost of capital. And so, our time cost of capital has gone up. And so we want a better valuation now because we're probably going to have a longer hold time on the investment. And these are the metrics that we play with when we're considering what valuations are. And it comes back to this question around risk and reward. And, it's slightly riskier now than where the world was. We're going to have longer hold times on our investments. We're willing to make the investments, but that probably means that valuations will fall. And I have to say, when I took my own company through the tech crash, I had to take a lower valuation, but I was actually one of the companies that actually survived the tech crash. And I saw so many of my peers.
Which one was that, Michelle? Just asking, which one was that?
We were one of Australia's first fintech, .com. Australia's first fintech companies, and we built the technology behind the Australian, New Zealand, and moving into the UK prepaid cards and electronic voucher market in the early .com days. So we were one of the survivors of that when many of our peers at the time fell away, and it was because we were willing to take capital. We, understood that valuations had adjusted, but we were in a position to come out strongly out the other side, and we did, and then grew a substantial business. So
I think the point around coming out strongly is a really important one. And what I'm maybe seeing that is a little bit worrisome is people holding to valuations that are sort of 6 months old valuations, but also not thinking about how that's going to impact their ability to raise 18 to 24 months from now, and not adjusting sort of, this is the growth I saw last 12 months. Is that actually going to hold for the next 12 to 18 months? If it does, great, then you probably will, be able to achieve those valuations because you'll be in this rarefied class of companies. But if you don't have high degrees of confidence around that, and you're raising at a very high valuation now, it's just going to probably be pain later down the track. So if you can meet somewhere in the middle, have a slightly more realistic approach on valuation now, fill up a war chest to come through this on the other side stronger, I think it's definitely worth considering.
We might be the dummies here, and I can see three of my colleagues all nodding at each other. At the seed stage, we haven't changed our approach to valuations in the slightest, and we've issued 3 term sheets in the last month. So I think the AirTree view on this is it actually depends on stage for us. If you're raising a late stage round when you're kind of closer to the public market, then we probably take more of a proxy from what's happening in the public markets, and in different sectors they're down different amounts, and I think you should expect growth rounds to come off accordingly. For us though, at seed rounds, we're typically providing sort of 24 months of financing for a company to go and hunker down and build product. And we're trying to set up the cap table such that the founders are properly incentivized and really want to build this thing for the long term. So for us, I think to the extent there were seed rounds where you had 5 venture funds beating each other up, those have probably changed because there's probably, I assume there's going to be less kind of highly competitive deals. But for the pure play, find a partner firm that you like, work with them on what a sensible amount of capital is for a sensible amount of runway. Our approach actually hasn't changed an iota at seed.
Yeah, I agree with that. I'd say anything like sort of pre-Series A, the maths haven't really changed. You're raising for 18 to 24 months, more like 24 months now. How much is it going to cost you to run for that? You shouldn't really be taking more than sort of 20-ish% dilution at that stage. That's evaluation. Like I'd agree with that. That hasn't changed. On the follow-on side in our portfolio, that's where we're seeing probably the start of the resistance. I would say people who started their fundraise 2 months ago, not much is moving, but people hitting the market now are feeling resistance. Particularly, I would say companies who were going to raise their follow-on funds from US venture funds. Some are just actively not taking meetings from companies that aren't in their backyard anymore. Their risk tolerance has gone down on a number of dimensions.
And you have to think that will flow its way to the seed situation at some point. It all flows downhill, really. So I think what you made the point, John, about less competition in the seed space, aggressively bidding up companies. I think you'll see that valuation, if it hasn't settled already on the seed side, I think it will start to sort of push down a bit. I mean,
it's just got to be a floor though, right? Like,
yeah, absolutely. Yeah. But, there was a no ceiling before.
Yeah, that's correct.
Yeah, I think it's also important just to be honest with people and say like really what it's going to be. And, and I've just experienced it multiple times myself personally. So I know this is what happens. And we all, we all want to fund companies and have the right cap tables and support our entrepreneurs. I mean, this is what we do for a business, and we love our companies and we get heavily invested personally in those businesses. Because our model, particularly OneVentures, we tend to have smaller portfolios. We're very hands-on and operational with those companies and help them through their journey. Just wanted to say on the clinical healthcare side, because I know some people here have diagnostics and therapeutics, it's actually about what stage the company is going to be sold at or list, and what we believe the valuation of that will look like at the time, and what big pharma are looking for and what they're prepared to pay for different types of technologies. And we actually have very good precedents on all that maths, and we run that maths back, and we actually know whether the company is going to need 100 million before it gets to exit, or whether it's going to need 30 million before it gets to exit. And we know the size of the market that it's targeting and whether it's a best-in-class application or a first-in-class application. And we look for those things, and that actually defines the valuations at the stages that we invest in those areas.
Thanks for that. I think valuations was a really big one that people are popping up and asking about in general. So it's really great that we spent a bit of time on that. We might actually start moving to some of the questions that are coming in live. One of the first ones that's up here is, what is the attitude of VCs to co-investing with strategic investors? Has this changed as a result of COVID-19?
I think we're seeing a lot of them, a lot of the corporate investors or corporate VCs are basically going into freeze mode. At least that's what I'm hearing. A lot of them, and this often happens, head office says, righto, you were investing off balance sheet, but we're not going to do that anymore. We've got to put all our cash into keeping the business afloat. And so the strategic investors just basically have to take a holiday for a while. So I don't know if anybody else is seeing something similar, but we've seen a couple of instances of that.
Anyone else?
I was just going to say, we've been strategics for a long time. Sorry, Mike, you were finishing? Yeah,
no, I was done. Yeah.
Yeah, we've invested with strategic investors for a long time, and we'll continue to do so into the future. But you always find in times like this, as Mike says, that the strategics all reevaluate their priorities and decide whether they're going to continue investing. And there'll be some like Intel that you'll probably never see fall away and pull out of, investing in capital, but there'll be other businesses that will certainly make a change, and we might see, contraction in corporate VCs.
John, Sam?
Oh, I'd agree with that. And the reason for that is the same as the advice we're giving our portfolio companies, right? Which is, trim fat but not muscle, and cut down on kind of unnecessary quote unquote expenses. For a lot of big corporates, their VC arm is a kind of bull market option. It's not part of their core business, and that's why you see them pull back. So I think we've got a term sheet for one of our companies right now from a strategic, so I don't think they're completely out of the market. But logic would tell you that there'll be fewer corporates investing in early stage venture going forward.
All of that makes sense to me. I'd say we've actually seen the opposite in our portfolio. We've seen more activity in strategics. In some cases, it's because they're trying to take advantage of some tailwinds that have been created by this current situation, and they know that if they were to try and spin up a team internally, they just won't have a chance of catching it. Equally, some companies have been trying to do something internally inefficiently, as big companies do, and they actually have a better chance of catching up more and actually cutting spend by investing now and wrapping it up with a strategic partnership or some sort of commercial agreement to take the benefit of the R&D or effectively the product or service that's being created off the back of that. So I think it really depends. The double-edged sword with strategics is always going to be they don't have the pure economic alignment that a VC investor has, but you can kind of manage that to some degree in deal structuring and the sort of agreements you enter into. The problem being, you form a relationship with Sally today, she'll be cycled out to another department in 2 years' time, and you'll, find yourself lost in a big corporate. Like, just go in eyes wide open that is a potential risk. But I would entertain the idea if you think it can be useful to your business right now.
Thank you. I know we said we're sort of pushing away from valuation, but we're back again. I've got a question here that's been up. So some of the panelists just announced investments at very high valuations. Some closed during COVID. How do the panelists feel about these investments now and the valuation paid? We may have answered a bit of that before, but it's there. I don't. Maybe you'd like to start, John. Or whoever it is that.
This is hard to answer without specifics. So I'd love to know which are the companies that have raised it at high valuations. The last investments we've announced, I think, are a Cloud Guru and Joyous probably, and I feel great about both those companies. In those cases, one is a cloud education provider and one is a employee manager communication software. So both of them are benefiting from tailwinds associated with remote work. But as I said earlier, we invest early enough and for long enough runways that that our approach to valuations 4 months ago and now really at the seed stage and to an extent at the Series A really hasn't changed significantly. So I feel terrific about investments we've announced recently.
Danica, it might be worth just sort of talking about like some of the funding options that are open for people as well, because I just passed some experience on from some of our portfolio companies. Some of them, particularly in the deep tech areas, are finding opportunities for, you know, unprecedented amounts of grant capital. So we've got one of our companies that's seeking $30 million from the US government right now because one of their therapies actually is an antifibrotic treatment, so for lung pulmonary cases. And the US government's putting a lot of funding into anything that might help either current COVID-19 or recovery from COVID-19. And they're going after one of those very big grants, quite likely to get that. There are other grants in other areas as well in the healthcare areas. A lot of foundations are putting money out at the moment. So, you know, I had a call from a foundation last week. They've just put $20 million aside for healthcare. You know, so we're seeing a lot of this activity that's a bit unprecedented. Gates Foundation pouring money into, you know, markets at the moment and trying to support what's going on in the world. And if you can take advantage of that, that's great. Don't forget as well, in deep tech, you have a big R&D check. There are people who will fund against that if you've got, you know, a regular, fairly regular R&D rebate that comes in. Look out for people who will do that. Obviously, the government incentives, use every single one available to you. One of our portfolio companies is in 3 geographies and worked out that they can access the incentives in all 3 markets, and they're looking at getting $2 million in incentives. Yeah. So look for those opportunities. Some of the other things that I used personally as an entrepreneur, getting my customers to pay in advance, even if I had to offer them a bit of a discount when I went through the tech crash. That was really important. I negotiated with one key customer to have an exclusivity for a 50% increase. And that basically saved the business, you know, meant I could pay my monthly bills. You can barter with people as well if you need a service and they need your service. There's invoice discounting that's available. And also remember that sometimes we think of strategics as external people who might want to buy our company down the track, and we look to them to invest. Sometimes your suppliers who are key to your business might invest in your business. And just after the, you know, .com 1 crash, I actually took an investment from a key supplier, and they were actually a really good investor because they had a vested interest in my future and doing, you know, getting a great outcome for my company. And they were really terrific investors. So they're just some things that I think are worth keeping in mind for you as you're trying to get your company funded. And funding can come from all different sources. It doesn't just have to be equity or debt.
Thanks, Michelle. That's fantastic, actually, going through all those different things. Does anybody else have a specific view on government-backed COVID loans in general, or the way that it might affect their investment appetite?
It would be great if it was more clarity that deep tech companies or pre-revenue companies could actually take advantage of a lot of these initiatives. It feels like, you know, without wanting to get really political, it feels like that's a forgotten part of the economy right now. And it's so important if we actually want to develop this deep IP and things that we can export, you know, on the other side of this.
Mm-hmm.
Yeah, I think there's still some doubt around the JobKeeper program and how it is applicable to startups or very high growth startups. So say, for example, you had $100,000 in revenue last financial year. This year you're on track for $1 million. You've got the cost structure to reflect that, but all of a sudden you've dropped the last 2 months and you're back down to 200,000. On paper you look fantastic, but you've actually got $1 million cost structure, not a $200,000 cost structure. But JobKeeper isn't going to help you with that. So there's some issues there. There's supposed to be some discretion at the ATO and the Treasury around this, but it's really not clear what that is.
Well, that's really problematic, right? You either need to know whether you keep people or you fire them, or you can't wait for the end of the financial year to
we've
find
given
that
such
out.
feedback in real time. Yeah, I mean, startups are making decisions in real time. You know, some of them are having to trim headcount as a result. It would be great if the policy intent is to have a program that keeps jobs versus discriminating against particular companies. It would be nice if that policy was applied across the board.
This is something we should talk to Startup Oz about. So Alex and the team are actively talking to Treasury about this, and the stated intent of Treasury is that it's meant to apply to both revenue generating startups but also deep tech startups. And I think what we've heard in our discussions with Treasury is that they'll look at a month-on-month basis, and we've seen that actually applied to a couple of our companies already. So I think this was an issue when JobKeeper was announced, but it's been properly resolved.
I'm not certain about that, John.
We have one around safe notes. So how has the appetite for safe notes been affected, and what are some of the conditions that have become more and less important in the consideration? Who'd like to start off on that one? Any takers?
I don't really have a comment on that. Honestly, the instrument is not. I mean, that's such a. It's secondary. It's like, do we love the company? Do we think it has potential, etc.
Yeah, that's the same for us. I think you will start to see some terms change moving forward. So for a while there was a lot of competition, particularly around investments in certain maybe top tier companies. And so founders could set the terms. I think you'll start to see a swing back to investor-led terms that might include, preference shares and things like that. I think you will start to see some maybe changes in terms. I mean, they're fairly common terms in Australia, but there had been a bit of a swing away from some of those, what they would probably call less founder-friendly terms.
Yeah, there was a tweet which I'll find and share in the channel later on, earlier around over the weekend, around bad VC terms coming back into usage, at least in the US. Haven't seen this in Australia as yet, but liquidity preferences, multiples, all that sort of stuff. There's a whole bunch of stuff that we know will probably come back, but was in the 90s or whatever, late 90s. There was, Michelle, you might remember, but there was quite a bit of what would you say, bad behaviour back in those days from VCs. Hopefully we won't see that come back, but we're hearing reports of it perhaps happening in the US already.
I really, I've heard the same things, but I've sort of heard them I haven't seen them in term sheets. I've heard them in blog posts and tweets, but I haven't actually seen them kind of filter through the term sheets yet. And I really hope they don't, because let's not forget, this is actually a really privileged position we're in. 10 years ago in Australia, there was almost no VC to be found, and that was because the best companies would just go straight to the US to raise. They wouldn't put up with bad terms, and we don't want a situation again where all the money leaves the Australian venture capital system. So I really hope it doesn't get to that point.
Speaking of traveling, how? Oh, sorry, who was that? Did I talk over someone?
Oh, it was me, Danica. Let me just. I think the question was specifically on safe notes, and I thought maybe it would be worth just reflecting on why convertible notes came to be in the first place. So the sort of potted history of convertible notes is when angel investors were sort of actively grouping up and investing in companies and trying to figure out what they were worth. They tended not to be professional investors. It tended to be a lot of them. There wasn't usually a strong lead. And so convertible notes historically came about as a mechanism for angel investors to finance a company for a period of time and then put off the valuation discussion until a professional investor did the seed or the Series A or whatever and priced their company. And so we, pre-COVID and post-COVID, we've invested in a few safe notes, and we'll probably continue to do that, but we prefer not to. And that's really because the institutions who invested in our fund have done so because they think we're professional investors and understand how to price companies. So on the kind of specific terms question, we prefer pricing rounds, not because we have anything against safe notes or convertible notes generally, but just because they're an instrument that weren't really originally designed for venture funds and aren't particularly well suited to them. And then on what terms we're using, we've actually open sourced our term sheet like 3 years ago. I'll put it in the chat, but we fully intend to continue investing on exactly the same terms.
Gotcha. Thanks, John. I was moving to a question before I rudely interrupted you on factoring in the travel restrictions for the next, like especially to Europe and USA, for the next 12 months, and how this will impact companies' ability to generate capital overseas. So are you factoring these into your, into the opportunities that you're taking on board?
I think if they haven't already, almost every VC fund is working out how to do remote pitching, everything by Zoom. I actually think probably Australian VCs, we're all pretty used to doing remote pitching, so it's actually more business as usual for us. Definitely for some US firms, it's not, and they're kind of, working out how to make that an optimal experience for both them and founders. But I think that that's where it's moved to.
I mean, I'd make the comment that I'm less worried about their ability to raise capital overseas than I am about their ability to learn how to sell remotely. For many businesses, it's a matter of hopping on a plane and going and visiting people, being in conferences, all that sort of stuff. What we're trying to actively encourage our portfolio to do is to become best in class at being able to remote market and sell their product. To be frank, the only way out of this for many companies is to sell their way out of it. They're not going to get out of this without actively building the business as they're going. Now, we know we're not going to ship much this quarter, but they can set themselves up for 6 months, 12 months down the track by not putting the brakes on the sales activities. Doesn't mean they spend a fortune on the budget, but they need to work out really fast how to sell and market their products remotely, because it's a different world to what most of them might be used to.
I think one of the other things is possibly remembering that if you bring on board a local investor that already has offshore relationships, that can potentially help you with your offshore capital raising. So we've, all the firms, people sitting around the table here that you're looking at, have all done deals with firms all around the world, both corporate VCs and, other institutional venture capital firms. And so our companies come to them through a very recommended channel. So often getting, the right partner on board locally can help propel you into those global markets and help you get, offshore capital as well.
I mean, the one way to get any of those excited is to sell a lot. If you're selling a lot, if your revenue is growing, somebody's going to get excited.
I'd say as well, I mean, that's not like, for some companies, that's not actually an option right now. Like, people aren't making purchasing decisions, etc. Like, obviously try like hell, but sometimes you've just got to make lemonade out of lemons. And I've seen some companies go, right, well, no one's got budget right now. I'll go free and I'll just go ham on engagement and soak up, you can't fight with free, right? Soak up all the available markets so that when people's budgets do come back, they're embedded in the organization, they're incredibly sticky, they've made people more efficient than otherwise, they've maybe enabled some companies to reduce headcount, etc. So you've just got to make the best of the situation that you find yourself in.
Yeah, I think that's a good point, and I think the distinction between customer buying behavior and your go-to-market motion are really important here. I think Sam's right. There's a whole bunch of people not buying when 3 months ago they were, and that's tough, undoubtedly. And there's a bunch of things you can try around that. And free is an idea that we've seen a few companies pursue as well. On the go-to-market motion point of view, though, I think the silver lining here is that everyone is trying to figure this out right now. So where you were previously at a disadvantage because your competitor was sitting in Denver selling to the head office of someone else in Denver, you're now selling head-to-head on exactly the same terms as them. So to the extent buying behavior shifts and people get used to remote selling, I think Australia's always suffered from a tyranny of distance that, who knows, this might be an opportunity for us. But, right now, no one's buying and it's tough. But I think the long-term impact of this may be a net positive for Australian companies.
And I would say in terms of the head-to-head, I don't actually don't forget, we have a major cost production opportunity here, right? Like, most people can, earn income in USD but spend in AUD, and
AUD.
you can out-survive your competitors in that scenario.
Yeah, we've got a partnership with an Israeli venture capital firm, and one of the things that they loved about Australian entrepreneurs was how good we were at bootstrapping our businesses, because they just don't see it in Israel, and Israeli companies don't also have access to a local market generally, so they're always offshore, and so always raising larger amounts of capital. And they've been super impressed with, you know, how entrepreneurial Australians are about how they go about funding their companies as well. And, you know, we've seen great companies like Atlassian come through that channel. So, you know, use your creativity.
I'd make the observation too that CPMs and other online marketing costs at the moment are dropping. And we're seeing data to suggest that they're sort of down 30% on what they were 3 months ago from a cost perspective. So it's actually probably a good time to spend a little bit of money on marketing, and especially if you're into a niche area. If you're in a, for example, you can target to a particular niche industry. Some of the websites that target those niche industries, their mainstay of revenue has gone, and they will do a deal. They're open for business. They'll take an attractive offer. So it might be worthwhile reaching out to the people where all your potential readers listen to and negotiating a great deal on some sort of sponsorship with them. Not to close deals this quarter, but for next quarter, the quarter after, and early next year.
Like, I think that's a great point. We had the Joyous board meeting last night, and they're doing exactly, just to give you a tangible example of what you're describing, they're doing exactly that. So what they've seen is that marketing efficiency has got about 70% more efficient for that business.
Oh, wow.
The counterbalance is that sales efficiency has fallen through the floor. So everybody's sitting around at home trying to figure out what solutions and they're all looking at things but not buying them. And so at least in Joyce's case, what they've made sort of active decision to do is to double down on marketing and pipeline build for the next 3 or 4 months, fully expecting almost no conversions, and they haven't invested into their SQLs or their sales funnel or the sales process accordingly. But they're really seeing the next quarter as a pipeline building opportunity, and then hoping that sales conversions pick up over time. I think the point you make is probably broadly applicable.
I want to just add one thing as well, which I don't hear enough people talking about. You know, between fundraisers, at least and I think most venture funds are assessing progress across 3 dimensions. You know, one is obviously product, how much you've built and how much you've achieved. 2, ideally, is customer traction. And the 3rd, importantly, is team building. And this is, if you are unfortunately in a situation where you cannot make much progress with customer, you're actually inhibited from building product because you can't get into labs or you can't get access to critical supplies or whatever. And this is obviously a very, unfortunate situation. Don't just sit on your hands. Use that time to build up your team, to solidify people around the vision, to work out what else you guys can be doing. Don't sort of forget your people and lose them, through the crisis or on the underside. I think that's a really important thing, because if you can demonstrate that all this shit happened to you, but 12 months from now, you've managed to retain this amazing team or even pick up talent that other people had to let go, that will be something that you have to talk about to investors 18 months from now.
Yeah, so there's supposed to be 3.3 million Australians who are going to be out of work soon. I can tell you that the best thing that came out of the tech crash was I actually picked up the most amazing development team for me, for my business, because so many people were suddenly looking for opportunities for work and we had access to terrific talent. So building that talent pipeline, and on the flip side, if you can't afford to keep your talent, stand them down, don't fire them or terminate them, because then when you get back up and running, you can scale up so much more quickly at the same time. So, talent's a really important discussion, and I'm glad you raised it, Sam.
And in terms of deep tech specific, do you think that VCs are aware of the Australian capacity when it comes to deep tech companies in this country, and how would you like them to approach you if they're coming to you?
Sorry, I missed the start of the question. What was that? Sorry.
Deep tech companies, do you think that VCs are aware of our capability as deep tech companies in Australia, like that we have
US VCs or overseas VCs, or?
I think it's a pretty global, global vision at the minute. Everyone's, you know, online and listening to each other. Do you think we have a presence, Australia, in terms of deep tech?
I think our research is second to none. You know, I think we're right up there. Whether we're fantastic at commercialising that yet, that's another question. But I think research-wise, the country has, you know, we're top level, you know, from a deep tech perspective.
And is there a specific way you think deep tech companies should be approaching this globally, with their, I guess, their way that they're, you know, being perceived right now? Is this the time to step up and really push out and approach VCs overseas, or stay within Australia?
I just think that depends on one, whether their business is growing quickly. If it's growing quickly, I don't think they'll have trouble raising capital. If they're in sort of survival mode, maybe not so much. I think also you just have to probably think about whether it's likely in the next 12 months you're going to get a tailwind or a headwind. For example, one of the companies we've got right now, CoView, which has sort of become the default telehealth platform for Australia, that's got a massive tailwind behind it. It literally has the J-curve, the growth graph is like that. It's fantastic to watch in the morning. And so, you know, obviously that company won't have any trouble raising capital. You know, other companies maybe not quite in that position. So I think it's a case-by-case basis. I think people acknowledge Australia has world-class research. I think you look, especially in your space, Michelle, overseas companies license off Australian researchers all the time. That's basically the default model, right?
That is.
So, you know, I don't think there's any question about, you know, Australia's admired, if you like, as a research powerhouse.
Yeah, one of our portfolio companies, Vaxis, is, you know, a vaccine patch company, and it's going to completely remove the need for needles for vaccination. And in fact, they were already engaged with the US government on pandemic response. And that company has, you know, seen 7.5 million recently come in from Gates Foundation. They're, you know, on track for another major grant. They've just signed a massive deal with Merck Pharmaceuticals. You know, so these companies in the deep tech space who have engagement and have a great product for the market can continue to raise capital. You know, and it's, as VCs, we're always looking for that 1%, the company that's really going to break through and, you know, have a game-changing technology. And if you're one of those companies, you know, you will find people that want to back your business, whether, you know, locally or overseas.
Sure. And are there any industries that are less attractive to invest into you guys at the moment? For example, the travel industry, or are you still keeping it very open in terms of in terms of your opportunities?
I think it would be a real mistake to just paint broad brush. No, I'm not going to look at that industry. If you took that approach, you know, in, you know, 2009 or something like that, you would have missed Airbnb. You would have, you know, you would have missed the nuance that, you know, the opportunities that get created in times of crisis. So I would say nothing is off the cards, but we just want to see evidence of a unique approach to acquiring customers, go to market, a unique insight into developing product, and you know, again, the horizon is a decade. You know, on the horizon of a decade, is this going to be a meaningfully huge business?
I think it also depends on whether you think this is a short-term problem or a long-term problem. And I must admit, personally, I'm looking at things from the perspective of how does this change post-COVID-19? Will COVID-19 change the world for this style of company or that particular company? Will they get the tailwind? Will they get the headwind? And so, in my mind, there is something to be considered there. But I think it varies case by case.
Yeah, that's a good point. I think this may not be the only episode or pandemic, or not, well, hopefully not another pandemic, but something major that could impact the way that we do business globally. And so I guess, do you have any advice for founders in terms of their resilience? Or I know we've talked about planning and having plan A, plan B, plan C, or short-term, medium-term, long-term. Is there any, as the last question, any, you know, major piece of advice that you have for them with regards to carrying on as we move to a future that's dramatically changed?
Don't run out of cash.
Yeah.
Keep selling. Keep positive. Don't run out of cash.
I think the positivity thing is honestly a point. Like, you know, what makes founders so incredible is their ingenuity and positivity and finding a way when, you know, everybody else wrings their hands. So just take that mindset into every day and be greedy and opportunistic, I would say, with this time.
Yeah, I'm going to be really generic and say that something somebody said to me a long time ago, when, you know, you get to the point where you feel like you're about to give up and then the tide turns. And if I can get you to take something away, is like, yes, use the ingenuity and things like that, and remember that the time will change and things will move back in your favour if you can just get through this crisis and find the way to do it, and use all the tools available to you, some of the things that I mentioned earlier, that help you get through with your business. And, you know, we really wish you well through this period.
Stay safe.
And John?
Yeah, I think we're going to see a lot of fair weather entrepreneurs go back to what they were doing previously. I think 11 years of a bull market means a lot of people probably started companies that shouldn't have. And I think if you're a founder and you get through the next 3 months and you're still dedicated to your business, then you really are a true entrepreneur. And then if you're in that category, then firstly, we want to meet you. But secondly, I think clearly sales and marketing are going to be tough. I don't know how long for, but they're going to be tough for the next little while. And so to the extent, as Mike said, you have the runway, now is a brilliant time to hunker down and build product, because all of your big incumbent competitors are suffering way worse than you because they've got massive offices. They're going through huge layoffs. They're generally not set up well for remote work. And so as painful as this may feel, being young, nimble, using modern tools and working remotely, actually, you know, it's painful for everyone, but it positions you as an advantage. So I think, you know, if you make it through this period and kind of define yourself as a true entrepreneur, and then you kind of have the means of hunkering down and really building out product, then whenever this thing's over, whether it's 3, 12, 24 months, you really will be well positioned to, you know, spring out the other side as a much stronger company. So this is going to be, you know, career defining and company defining period for the true entrepreneurs out there. But I think, I think great companies will emerge from this.
Okay. Well, our time is up, everybody. I think we could have easily gone on for another hour. Actually, there are still so many questions. It's been a really insightful hour, and I hope it's helped many of you listening in. I really want to thank our panelists today for their time and for sharing their valuable views. To those of you that joined us, thank you as well out there. We can't see you, but we know you're there. I just wanted to take an extra second to say that if you're interested in the monthly buzz, please join us again next month. Just sign up to the Cicada newsletter and you'll be kept abreast of all the things that are going on. We actually have a Managing Cyber Risks remote work on Wednesday at 12 p.m. I think it is, for an hour. So feel free to join us for that one as well. There will be a survey post this so we can continue to improve our events. And I'd just like to say we hope you're all keeping safe, and reach out to Cicada if we can help you in any way as well. Thank you to all of our panelists for an excellent discussion. Really, really
fantastic. Thank you.
Stay safe, everyone.
Keep safe, everybody. Yep.
Bye.
Thanks.
Bye. Good luck.